welcome to Economic Insights. I'm your host, Alex, and I have with me, as always, Salim, a market veteran of many years and our producer. Welcome, Salim.
Hello, Alex. Good to be here. Though I have to say, this is not a week I particularly enjoyed watching from the market side.
I can only imagine. There's only one word for this week: war.
It changes everything we thought we knew about where markets and more.
Let's go through it. Last Saturday, U.S. and Israeli forces launched military strikes on Iran. I believe this was called Operation Epic Fury. What happened and how did markets react?
The strikes were comprehensive. Military facilities, naval assets, missile production sites, and in a dramatic turn, Iran's supreme leader, Ali Khamenei, was killed. Iran's response was swift and severe. The Revolutionary Guard announced the closure of the Strait of Hormuz, and retaliatory missile strikes were launched against U.S. military bases across the Gulf. Qatar, Kuwait, UAE, Bahrain, all of them were hit. This is not a skirmish, this is a war that has the entire Middle East as its theater.
And Brent crude immediately spiked over 7% when markets opened on Monday.
That was just the opening bell. Vessel traffic through the Strait of Hormuz, which carries roughly 20% of the world's oil and a similar share of its liquefied natural gas, essentially halted. Qatar Energy declared force majeure and shut down its LNG facilities following drone strikes on their Ras Laffan plant. Iraq started shutting down oil production at its major fields. By end of week, Brent had pushed past $90 a barrel. And crucially, the market now believes this isn't going away quickly.
How much oil supply are we actually talking about being removed from the market?
After just 7 days of the Strait being effectively closed, analysts estimate between 2 and 2.5 million barrels per day have already been shut in. Storage capacity in the Gulf is filling up rapidly. If nothing changes by day 18, you're looking at nearly 5 million barrels per day of disruption. And the arithmetic beyond that becomes quite grim. All regional producers could exhaust their onshore storage buffers within 25 days. The worst case scenario, a full sustained blockade, could push Brent between $130 and $150 a barrel.
That's an extraordinary number. $100 oil in an already fragile global economy.
Correct. And that's where it becomes truly dangerous. Because unlike in the 1970s, when high oil was simply inflationary, we now combine a potential energy price shock with a labor market that already showed its first cracks this week, just as the war is adding upside inflation risk at the same time. That's a particularly unpleasant cocktail.
Let's talk about those jobs numbers because that was the other major shock of the week.
February non-farm payrolls fell by 92,000. That's a decline, not just a miss. The unemployment rate ticked up to 4.4%. Now there are some technical distortions. A healthcare workers' strike involving 31,000 workers. Some statistical adjustments that shifted roughly 100,000 jobs from February into January. But even stripping all of that out, the underlying trend of job creation appears to be somewhere in the 30 to 45,000 per month range. That is a slow hiring economy.
Is the labor market actually breaking then?
Not breaking, but clearly softening. The important distinction is that layoffs are not surging. Jobless claims stayed steady at 213,000. Companies are managing headcount through attrition rather than firing people. What's changing is hiring. The combination of tight monetary policy and the slowdown in immigration flows has compressed job creation. It's a low hire, low fire environment. The problem is that the economy needs some level of hiring to sustain growth.
And then you combine that weak jobs picture with an energy price shock.
And you get the word no central banker ever wants to say in public. Stagflation, higher inflation because of oil. Lower growth because of a weakening labor market. And a Fed that now has absolutely no room to maneuver. If they cut rates, they risk looking like they're ignoring an inflation shock. If they keep rates high, they accelerate the slowdown. It's an almost perfect storm of bad timing.
Let's go deeper on the developed markets, starting with the U.S. rates picture.
Before this war started, Markets were pricing in a couple of rate cuts from the Fed by mid year. That's now effectively off the table. The energy shock adds upside inflation pressure, and the Fed has been very clear that it intends to protect its credibility. Critically, if oil goes to $100 and stays there, analysts estimate headline CPI could breach 3 to 4%. That's not temporary, that's a problem. And the Fed's preferred measure, core PCE, was already running at around 3.1% before any of this.
What's happening to Treasury yields?
A very volatile week. Initially, investors fled to treasuries as a safe haven, pushing yields down. Then, by the end of the week, the repricing of central bank cuts sent yields higher again. The bond market is essentially saying if oil stays elevated, the Fed can't ease. That is a brutal environment for anyone who was counting on rate relief.
And Europe? The Eurozone is not exactly in a position of strength when oil rises.
Europe is arguably more exposed than the US. The Eurozone imports roughly 95% of its oil and 89% of its natural gas. The US is now a net energy exporter. It actually benefits on the production side from higher prices. Europe just takes the pain. The energy price shock is a straight hit to real incomes and corporate margins. The ECB was on a cautious, steady path. That path is now deeply uncertain. If oil stays elevated, the ECB faces a choice between tolerating above target inflation or hiking rates into an already fragile economy. Neither option is great.
There was also a data point midweek. Euro area flash CPI surprised to the upside.
It did. Core inflation jumped to 2.4%. Services prices are sticky. Wage pressures are there. This was before the full impact of the energy shock filters through. The ECB will be on watch. Germany's manufacturing PMI had just returned to expansion for the first time since mid 2022. Italy was showing momentum. These green shoots are now in danger of being trampled.
What about the UK? We had the spring statement.
The spring statement almost became an afterthought the moment the war started. Markets had mixed reactions. More importantly, for the Bank of England, UK rate cuts are being pushed back. The energy exposure through natural gas is significant for the UK, and wage growth remains elevated. Cuts that were expected in March are now likely delayed to April or later, or possibly much later, depending on how this war develops.
Japan is perhaps uniquely vulnerable to this conflict.
Japan imports 96% of its crude from the Middle East. 96%. So when the Strait of Hormuz goes dark, Japan is staring at a structural shock to its import costs and its trade balance. A 10% sustained rise in energy prices could add at least 2 trillion yen to Japan's import bill, pushing USD yen higher, which ironically hurts Japan further by making everything more expensive to import. The Bank of Japan had been on a path toward gradual rate hikes. That timeline is now in serious jeopardy. If oil goes above $100, April hike expectations are effectively dead. The BOJ is watching closely because this is demand destructive inflation, not the good kind they've been trying to cultivate.
Let's move to commodities. I have to ask about gold, and because that was a strange story this week.
It was. You'd expect gold to rally in a war. Safe haven demand, inflation hedge, all of that. Instead, gold fell about 3.5% over 2 days at the peak of the panic. Silver also got hit. And the reason is actually not that mysterious if you've been around markets long enough. When a shock is severe enough, leveraged investors get margin calls on everything. They sell what they can, not what they want to. Gold was a liquid asset that hedge funds could sell to raise cash. It was a forced liquidation. The expectation is that once the leveraged positions are cleared, gold will resume its role as a geopolitical hedge.
What about the dollar?
The dollar strengthened sharply, which is the typical response, but with an important nuance. Unlike past oil shocks, the US is now a net energy exporter. So a high oil price is actually not a negative terms of trade shock for the US the way it is for Europe or Japan. The dollar benefits on two fronts: safe haven demand and insulation from the commodity shock that is hurting its trading partners. If Brent sustains a move above 100, strategists think the broad dollar could appreciate an additional 2 to 4.5%. That's a meaningful move.
And crude itself? Should I attempt a crude pun?
Stop. Not another one. Brent ended the week above $90 a barrel. That's up substantially from where we were. The numbers are dramatic. The initial spike was 15 to 20% within the first days. Near-term projections have $100 as the central case if the Strait remains disrupted. If it doesn't reopen within weeks, the circuit breakers, strategic petroleum reserve releases, OPEC spare capacity, pipeline diversions, simply don't have enough capacity to fill the gap. Saudi Arabia and the UAE together can divert maybe 3.5 million barrels per day through alternative routes. The Strait normally carries around 16 million. The math doesn't work.
And aluminum got caught in this as well?
An underappreciated angle. The Middle East produces about 9% of global aluminum and exports 18% of ex-China global demand. Smelters have shut down due to suspended gas supplies. Bahrain declared force majeure. These smelters have only 20 to 30 days of raw material inventories. If supply chains stay blocked, aluminum prices could push toward $4,000 a metric ton. It's a supply shock that will hit industries far removed from the oil sector: automotive, packaging, aerospace.
Let's move to emerging markets, which have had a brutal week.
The war has hit emerging markets through multiple channels simultaneously. Currency weakness, higher inflation, current account deterioration, equity outflows. The GCC countries are at the epicenter. The immediate question for them is stability and then economic normalcy. Their balance sheets are strong and the oil price rise is a revenue windfall. But civilian infrastructure damage, closed airspace, and the disruption to shipping and logistics is a real near-term cost.
Let's go through some of the key ones. Turkey first.
Turkey is heavily exposed as a major oil importer. A $10 per barrel increase in oil adds about $2 billion to Turkey's annual import bill. In a $100 Brent scenario, the direct impact on Turkish CPI could be over 5 percentage points. That's on top of inflation that already ran at 31.5% in February. And there is another dimension that is specific to Turkey. It sourced 14% of its natural gas from Iran in 2025. That supply is now at risk. The central bank has already tightened its effective lending rate to 40%. On March 12th, the policy rate decision is expected to be a hold at 37%. The rate cutting cycle is on ice. On reserves, Turkey is in a much better position than it was in previous crises. Over $200 billion in total reserves, strong gold holdings. Every $100 rise in the gold price adds about $2.5 billion to the value of those reserves. That's a meaningful buffer. But the geopolitical proximity, Turkey is the nearest major economy to a collapsing Iranian state, brings tail risks that are hard to price.
What about Egypt? They have their own version of this problem.
Egypt is in a difficult spot. It's an energy importer. Its Suez Canal revenues take another hit as shipping avoids the region. Foreign investors had built up large positions in Egyptian local debt, one of our favorites. Those investors have started unwinding. The Egyptian pound has depreciated over 4% in the space of days. Egypt's reserve buffers have improved substantially over the past year, which is the saving grace here. But the situation bears watching closely.
Pakistan?
Pakistan is one of the most exposed frontier markets. It imports 81% of its energy from the region. A 10% rise in oil prices hits Pakistan's GDP growth by 0.3 to 0.4 percentage points and widens its current account deficit by half a percentage point. That's from an already precarious external position. Pakistan is essentially staring at a reversal of the fragile stabilization it had achieved over the past year.
India?
India is the world's third largest oil importer. Every $10 per barrel sustained increase in oil widens India's current account deficit by 0.4% of GDP. The rupee will feel sustained depreciation pressure. The Reserve Bank of India's easing cycle, which was just getting started, is effectively paused. Inflation forecasts are being revised upward.
And China, which was already in the headlines this week for its own reasons?
Yes, the National People's Congress, China's annual legislative meeting, set the 2026 growth target at 4.5 to 5%. That's the lowest target since 1991, and a nod to the reality of slower structural growth amid geopolitical headwinds. On the Iran shock specifically, China is more insulated than most. Oil and gas together account for only 27% of China's energy consumption. The rest is coal and renewables. That buffer is real. However, 53% of China's crude imports do transit the Strait of Hormuz. The central bank is managing yuan stability carefully, and rising oil prices could actually help China exit its persistent producer price deflation. So a mixed picture, but not a crisis.
What should we watch next week?
The war itself, above all else. Any escalation or any sign of de escalation will move markets far more than any data release. But the data is not irrelevant. On Wednesday, US CPI for February expected around 0.3% month on month. Given what's happening with energy, any upside surprise is a real problem for the Fed. On Friday, personal income and spending data, which includes core PCE, the Fed's preferred inflation gauge. That's expected around 0.3 to 0.4% month on month, keeping the year on year rate near 3.1%. These are not reassuring numbers even before the oil shock fully feeds through.
And from EM in Asia?
China releases February CPY and PPI on Monday. Turkey rate decision on Thursday, March 12th. A hold is almost certain. India CPI on the same day, expected to edge up slightly but remain manageable. And UK GDP for January on Friday, expected to show modest 0.2% growth, though that feels like ancient history given what's happened since.
Well, we will certainly be watching all of that. Selim, any final thoughts?
Markets had spent the early part of the year pricing in an optimistic scenario. Disinflation continues, central banks ease, earnings hold up. In the space of 1 week, a war has put all of that in question. The uncomfortable truth is that if the Strait of Hormuz stays closed for weeks rather than days, we are in a fundamentally different macro regime. Stagflation is not a tail risk anymore. It is a base case. And the instruments that normally protect you, duration, gold, behaved counterintuitively in the initial shock. That tells you something about how disorienting this environment is. Stay alert, don't reach for yield, and respect the uncertainty.
That's very sobering.
Thank you, Alex.
That's all for this week's Economic Insights. Don't forget to like and subscribe. And don't forget, folks, we do not give investment advice. For that, please consult a professional. Until next time, good luck.